Tax Reform Legislation Analysis, an overview of the Tax Cuts and Jobs Act of 2017, was a live webinar that was originally produced on Thursday, December 21st, 2017. For this webinar, I was joined by Mark Heath, one of our partners here at McKonly and Asbury. We hope you enjoy this recap, and please visit us online at www.macpas.com for more information about our future webinars and other events.
Well, as we said, thanks again for being here. We are excited to talk through some of the changes and some of the aspects of the new tax bill. And Mark, before we get started, if I could just ask you kind of a big overarching question is what stands out to you the most in this new legislation? Kind of what's the thing that you see this aspect and you think, okay, this is a big one for me, or kind of stands out for you?
Well, if you ask me what stands out, first the process that all of this went through and how quickly this was done. There's been a lot of comparison to the Tax Reform Act of 1986 and how revolutionary that was, and it was revolutionary at the time. That was in process for over 2 years before they actually signed it and enacted it, I believe. Right. And this, this all happened over a span of 6 weeks. And no, clearly the ideas that were being discussed were in people's heads long before this. But as you saw, when the Senate passed the first version that one Friday night, I believe it was December 1st, they had a really big oops in there when they put when they left corporate AMT in place, which the next morning someone pointed out and said, "Hey guys, you just made R&D credits worthless." And so I think that kind of speaks to the process and how quickly it went through, for better or for worse. It is what it is. And so I do have a bit of a concern that at some point here in a few months, something's going to pop somewhere and somebody's going to say, yeah, we didn't really think about that. So there may be some unintended consequences in this. And they could be good unintended consequences, depending on which side you're on here. There could be good unintended consequences where someone gets a tax break that they weren't necessarily intended to get or expecting. But as far as the actual legislation goes, I mean, clearly the drop in C corporation tax rates from 35 to 21%. Most C corporations are taxed at 34%, but the max rate is 35. So that's the number you largely hear, and not just from a cash flow perspective, but from a financial reporting perspective for C corporations who have large deferred tax liabilities on their balance sheets. That deferred tax liability is valued currently at either 34 or 35%, and most companies, many C corporations have deferred tax liabilities because of the accelerated depreciation on fixed assets mainly. So these companies have been getting tax deductions against against income that otherwise would have been taxed at 34 or 35%. Now that's going to be taxed at 21%. So they're going to see a really big financial statement impact from this. Right. I was just speaking with someone who deals with the SEC the other day, and we were curious as to how the markets were going to react when these large corporations have this huge jump in profits. It is a cash benefit down the road, but it's not an immediate cash benefit. It's not like their sales went up. It's not like their operating income went up. So we'll have to see how the market reacts to that, how investors react to that, and whether or what kind of impact that tax benefit is going to have on the markets and everything else.
Yeah, Mark, I like that. I think exploring what this really does mean as far as the, all things being equal, financial statements of publicly traded companies now are going to have lower tax expense, higher earnings, more cash available. What does that do to the market that's already experienced some pretty record highs and record growth as well? So one of the things that stands out to me is this isn't reform in the sense, you brought up 1986, Mark. This isn't tax reform in the sense that 1986 was. And the reason I say that is the foundational aspects of our tax system were not changed by this bill. We changed rates, we adjusted rates, we got rid of certain deductions, added some other deductions. In a lot of ways, some of these provisions, when you look at them, all of them as a whole, comprehensively, it seems a little scattered. You have certain things helping certain individuals in a certain situation financially, while other aspects may be hurting those same individuals. But I don't know if you agree with this, Mark, but we didn't have true foundational or true reform to the foundational aspects of our tax system. We certainly didn't simplify it at all with this bill, right?
That is one thing they up front they sold this, that it was going to simplify things, and for some people it did. For the vast majority of people, well, in sheer numbers wise, I'm not sure how it'll all fall out, but for the people who they're saying it will simplify it even more, their taxes, while they might have thought they were complicated, from their standpoint, they're still going to think they're complicated.
Correct.
Whether or not they were simple before and or more simplified now, it's still going to look complicated to the layperson, and that's why I have a job. So I'm not going to belabor that point. But it's very interesting because early on in the tax reform process, I met with both Senator Toomey and our local representative in Lloyd Smucker in Lancaster, and kind of the first words out of my mouth were, "Hey, I know you keep saying this simplifies things, just so you know it doesn't."
Right.
And it's sort of a little bit of a shell game, and I don't mean that in a malicious sense that they're trying to sneak something past anyone. But Dan, like you said, so the big talk. One of the big talking points was we're doubling the standard deduction. Yeah, that's great. Thanks. You doubled the standard deduction. However, you took away personal exemptions.
Right.
So did you really double anything? Not really, because you took something away. But then at the same time, the child tax credit went up to $2,000, and they increased the income thresholds, at which point those would get phased out. So, Dan, like you said, they're taking from one hand, and putting it over into another. I think the original intention was, I will give them this, I think the original intention was we're just going to get rid of all these deductions. We're going to lower the rates.
Right.
We're going to give one big standard deduction. Everybody's done. There's going to be winners. There's going to be losers. But this is why tax reform is so hard, because you can't, because then the losers in all of this start screaming, hey, that's not fair because of this. And so then representatives and senators will throw something in to make them whole. And then the people who were winners are like, well, hey, I'm not winning as much anymore. I thought I was going to be winning. And you told me there'd be so much winning. And so then you put a little bit more back in there, but then all of a sudden it doesn't meet the Byrd rule in the Senate. And so you have to put some more revenue back in there for the government. And so it becomes, so we're kind of back to where we started. Yeah. It looks different, but like you said, this is not wholesale tax reform.
Yeah.
The IRS is not going to, we're nowhere closer to the IRS sending you your tax return and you just verify that it's correct and sign it and send it back. There's no postcards that people are going to be filing on. So wholesale tax reform did not happen. The income, by and large, that is being taxed is pretty similar to what it was a week ago. Just the rates are different.
Yep. I think along those lines, I did chuckle when the conversation about the postcard came up and it was in the news, because for individuals who are in the most simple income tax situation, there already is the availability to file a one-page return with the IRS on a Form 1040-EZ that, for all intents and purposes, is as simple as the postcard that they were talking about. That has existed for years. That's not anything new. But yeah, Mark, just to piggyback off what you said, we did not simplify things. We traded off certain complications for other complications. We lowered rates a little bit from where they were, but from an individual perspective, nowhere near their lowest. Actually, not even as low as they've been in the last 15 or even 10 years. So with that being said, I think it was just, for us at least, that is the foundation of understanding that, hey, let's look at this as some adjustments, some changes, some modifications to our existing system, but let's not view this as, oh my goodness, we have wholesale changes to the system of federal taxation. All right, so along those lines, let's just jump into a couple of the key aspects on the individual side from this bill. So under pre-act law, individuals are subject to 6 different tax rates. You see them there in front of you, 10% all the way up to 39.6%. So the highest margin rate was 39.6%. Just to give you some context, in 2017, that highest marginal rate for a married couple, you'd hit that at about $470,000 of taxable income. So for years beginning after December 31st, 2017, and you also see there and before January 1st, 2026, because some of these changes are right now as part of this bill will go away after certain numbers of years. So at least for the next 8 to 9 years, the brackets will be as you see in front of you. We expand to 7 brackets, the highest of which is 37%, as opposed to that 39.6. And the other point is that you don't reach that 37%. Married filing joint will reach that 37% at $600,000 of taxable income. So $600,000 to eclipse the highest bracket in 2018 going forward, where we were at $470,000 for a married couple in 2017 law. So you also see there just a small blurb that the Act also provides 4 brackets for estates and trusts. Estates and trusts always have a kind of a scaled down version of the progressive brackets of individuals, and you typically get to the highest income tax bracket really, really quickly in estates and trusts. So again, no foundational changes to that. They just have the kind of the same rate adjustments as we saw on the individual side. It's important for me to point out here that this is still higher than what we had in what was known as the Bush-era tax cuts, which were in place in the U.S. for quite a while. Back then, the highest rate was 35%. So we're somewhere in between the tax structure that we had at least the last 4 to 5 years and what we had in the Bush-era tax cuts, which ended up being around for, I think, 12 years in total that they were around. So, we're kind of in between there. We haven't gone completely back down to the level of the Bush-era tax cuts, but we also certainly do see some relief, especially at some of the higher income tax brackets.
And the net investment income tax and additional Medicare tax, they still are in there on top of all these?
Still there, have not changed. On the individual income tax side, Mark, the only change that's part of the Affordable Care Act is the individual mandate for health insurance is gone. So the IRS in your tax form was calculating a penalty for not having individual health insurance. That's no longer part of the tax system. It will no longer calculate, collect, and enforce that penalty. But the net investment income surcharge still continues to be in place.
And I've also heard some questions on why are these tax rates set to expire? And the answer to that is it's a procedural rule with the Senate, where the only way they could pass this was with 51 votes. Usually you need 60 votes, but the only way they were going to pass it was with 51. And in order for it to pass with only 51 votes, it has to not increase the deficit over a period of 10 years. So that's why they had to let these expire after 6, 7, 8 years, so that when you do the math, it works over a period of 10 years. Right. Now, what they're betting on is that after 3, 4, 5 years, there's going to be an increase in GDP, the economy is going to grow, and so even with the lower tax rates, the tax is going to be calculated on a bigger number, and so revenue will increase, and we'll be back in the same point as if they hadn't lowered rates, and obviously everyone finishes ahead.
Yep.
So if anyone out there has a crystal ball and can let me know if that's going to happen, that would be great. In the meantime, we'll just have to wait and see.
All right, so let's move on. We're going to hit on quite a few individual tax changes that we have in this bill. And, of course, there's a lot of detail and sometimes behind these exceptions and the fine print. Mark and I did read through the 600-page bill numerous times over the last 3 days. There are a lot of specifics here that, maybe limitations or other pieces related to these aspects that we maybe won't dive into completely, but at least these are the high-level things that we really see as changing on the individual side. So the standard deduction, Mark hit on it earlier, it increased quite a bit. Actually, it almost doubles for most taxpayers. So to give you some context, in 2017, the standard deduction for single taxpayers was $6,350. That shoots up to $12,000. For married filing joint, it was $12,700 in 2017. That's shooting up to $24,000. So again, we are making more deductions available to everyone across the board. And the standard deduction, again, you could either take the standard deduction or you can itemize, meaning you can have all of your specific deductions added and totaled. So what this means is a lot of individuals who didn't otherwise have enough itemized deductions, they now will get more deductions against their income and calculating things on the individual side. So quite a big jump in almost doubling standard deductions. We're going to touch on this again when we get to some other areas because there's some itemized deductions that have been lost or taken away. So this increase in the standard deduction coincides with some of those. Second thing is personal exemptions are suspended. This is actually really an interesting change. So, who is a dependent on your tax return has long been, kind of a big part of our tax system. So every individual has their own dependency exemption. So yourself, if you're married, your spouse, your children, potentially other relatives or people that you are caring for. So personal exemptions are now gone. So each individual that you claimed as a dependent afforded you a $4,050 personal exemption in 2017. So that means if you had 2 kids and you were married, you had $16,200 that you got to deduct from your overall income that would otherwise be taxable because of these personal exemptions. That is now gone. So again, think about standard deductions shooting up for a lot of people, but personal exemptions going down. This is why when Mark, you mentioned earlier, the idea that we've taken some things away, given some things in another area, it's tough to judge exactly what they were looking to do. The intention was when you see what seems like a lot of competing or different bills or aspects that compete with each other as far as who's going to benefit from them and who may be worse off from a tax perspective.
Yeah, I just had a thought that, and unfortunately this is recorded, so I'm not going to be able to deny that I said this, but I feel really badly for the IRS. Because here we are, December 21. Technically, this isn't even enacted yet unless the president just signed it, and I haven't checked Twitter in the last 5 minutes, so it hasn't even been enacted yet it's taking effect on January 1.
Right.
And so the IRS has to deal with all this, has to deal with all the questions, withholding, quarterly estimates, and the IRS, like most government agencies, are woefully understaffed. And so they have no say at all whatsoever in writing these rules, but they're the ones who have to deal with the fallout.
Yep.
And another just quick thing I wanted to point out, technically the personal exemptions, the law reads, for tax years beginning after December 31, 2017 and before January 1, 2026, the deduction for personal exemptions is effectively suspended by reducing the exemption to 0. That's code for personal exemptions are not gone. They're still there. They're just 0 right now.
Yeah.
So in 2026, 2027, they come back. Right. Without changes.
Yeah.
So they bake these little things in there that will flip back unless they do. Maybe it's job security for them. That will flip back unless they do something else for it.
Right. And you see there on the screen, there's a couple things that you'll notice, and Mark, I appreciate you pointing it out, where we have down that they're suspended, personal exemptions being one of them, because they just effectively have reduced the personal exemption amount to 0. But there's other aspects, and I haven't been able to read and haven't seen the detail of this, but Mark, things like the earned income tax credit, which benefits a lot of lower income individuals, depending upon the amount of dependents they have, it greatly affects the credit that you take. So I wonder if one of the other reasons or motivation for keeping it is that the determination of how many dependents you have is important for other aspects of the tax system.
Even if you're not getting a deduction.
That's right. Even if you're not getting a deduction, it may otherwise be important. And I know the other piece too, FAFSA, application for financial aid. Like a lot of these things are driven off of the number of people you have in your household, and they look at the IRS, your tax returns, the IRS forms to determine that. So I wonder if the thought is we can't completely get rid of it because it's relied upon for other reasons. But as you said, we're going to effectively reduce the dollar amount of the deduction for the exemption to 0. So picking up right off that, child tax credits increased and expanded. So pre this bill or pre-act law said that you had $1,000 credit for every child that you had, and the child had to be under age 17. And that is now expanded to $2,000 per child. But wait, there's more. They also greatly increased the phase-out limits for the child tax credit. So it is up to now $400,000 for married filing joint, or $200,000 for all other taxpayers, well beyond the $115,000 that the phase-out started at for married filing joint taxpayers prior to this bill. So again, go back to that. Personal exemption's gone. We get no additional deduction from taxable income for having a dependent. Typically, a dependent is your child, but in some cases, it's not. It could be an older relative, it could be a niece or nephew, it could be anybody else that you're just offering support for. So those are no longer in place, but we are expanding quite a lot, actually, the credit that we were getting for the child tax credit. So again, taking away some of the benefit of providing a household for dependents on the personal exemption side, but then increasing it. This, I believe, Rubio fought pretty hard for expansion of the child tax credit, if I remember correctly, and he seemed to have gotten what he wanted, at least to represent his state. So, this is kind of an interesting one. Again, an example of maybe competing objectives within some of the aspects of this bill. The next one was talked about pretty extensively, and that's the limitation on the state and local tax deductions. So on your itemized deductions on your Schedule A, you were typically allowed to deduct all real estate taxes on an unlimited number of properties, plus all the state and local income taxes you paid. That is now gone. You are now limited to a max of $10,000 between your real estate taxes and state and local income taxes. That can be part of the calculation of your itemized deductions. So by this being heavily limited, it also pushes more people towards using the standard deduction, which is now increased. So for some taxpayers, this will be a wash. For some, it will result in less deductions. And for some who maybe didn't have a lot of state and local income taxes, of course, the standard deduction going up quite a bit will result in a pretty good increase for them. It's worth noting here, and we're going to get pretty deep into the tax geek stuff now, but it's worth noting that state and local income taxes and real estate taxes were always an add back for AMT purposes, which means if anyone was subject to alternative minimum tax, they were not getting the benefit of state and local income taxes as far as a deduction is concerned. So for a lot of taxpayers, and AMT has changed, and we'll get into that in a little bit, but for a lot of taxpayers, even though their Schedule A included a large deduction for real estate taxes and state and local income taxes, they were not actually getting a benefit from it overall. So again, this is not an across the board helps everyone, not an across the board hurts everyone. It's really dependent upon individuals' specific circumstances. And then finally, the last point down there is the mortgage interest deduction, which is limited to $750,000 of principal. Before this act, you can only deduct interest on $1 million of principal for qualified residence interest. So it had to be, again, interest on your first or second home. We've gone down from $1 million to $750,000. So if individuals have mortgages on personal residence greater than $750,000, the IRS does provide guidance of a calculation on how you have to limit the amount of interest you get to deduct on your Schedule A. So all they've done is rolled this limitation down a little bit. So they lowered this so that more people, hypothetically, are going to be affected by this limitation. So, Mark, this one is really interesting to me, and this is maybe my lack of economic knowledge or background, but as a guy who grew up in New York City, I'm fairly familiar with the difference in home values, and then based on that, the difference in mortgages from a place like we are in central Pennsylvania area versus New York City. And why I find that interesting is, what is a $300,000 house here could very easily be a $2 million house in New York City, right?
How much does a one-bedroom apartment go for?
Well, it depends on where it is, right? Like in Manhattan.
In Manhattan.
Well over $1 million, probably, depending on the areas you're in, or a few $100,000. So I find it interesting that these limitations are set on a national level as it pertains to income taxes, but they mean completely different things regionally based on where you are. So let's just say if the intent of this is to limit the amount of interest deduction based on if someone has a really, really expensive home, well, that's all relative to where you live. A $750,000 home is not relatively as expensive in New York City as it is in central Pennsylvania. So I always think these are kind of interesting provisions when they set dollar limits on things like this that are so regional. but yet the limits apply to everybody regardless of where they live.
And the same thing goes with the phase outs of deductions and credits. Obviously, a $50,000 salary in Central Pennsylvania is probably minimum of $100 in Manhattan, and so same thing goes for a $250,000 salary and $500,000 salary. You have the same standard of living, but yet because you live in New York City, your tax answer is completely different, and we're not even talking about state income taxes yet.
Yep. All right, a couple of the other key aspects. Charitable deductions. Typically, cash contributions that you make were subject to a limitation of 50% of your adjusted gross income. So if your adjusted gross income is $100,000, you can only deduct on Schedule A $50,000, 50% of it. They up that limitation to 60%. I've done quite a few individual income tax returns in my life. I don't see, even really, really generous individuals, you don't see a lot of people butting up against this 50% limitation.
The only time I can recall ever seeing it is retired individuals with very little income, but a whole ton of money.
That's right. A lot, still large portfolio, not producing a lot of income, but and still giving a good amount. That's a great example, Mark. That's certainly one that it applies to. So they've upped that limitation to 60% now. So that same example, $100,000 of AGI, you can now include as an itemized deduction 60% or $60,000 of charitable contributions. All right, the next one, the miscellaneous itemized deduction limitation, the piece limitation, or as they called it. So miscellaneous itemized deductions first. Those are suspended. There was a couple different types of miscellaneous deductions, including unreimbursed employee expenses, tax preparer fees, investment expenses. Those are now gone. Those were subject to a 2% of AGI limit, meaning you needed to exceed 2% of your adjusted gross income before you could factor them into your itemized deductions. That's now gone. So they completely got rid of those. Pointing out here, too, those were added back for AMT purposes. So there's kind of a wash here for a lot of individuals who are subject to AMT, never got the benefit of those to begin with. And a lot of individuals just didn't have high amounts of these deductions. So these are now gone as well. I'll count this as a simplification. I'll give them one mark. This one is a simplification.
Yeah, I would agree with that.
The second one, the piece limitation. This is the overall limitation on itemized deductions. So the overall limitation of itemized deductions essentially used to kick in if you're married filing joint, if you had AGI of $313,000, if you were single, $216,000. And it basically took away a portion of your itemized deductions for every dollar that you had income over those amounts I just listed. So that's now suspended, and I'll use the same word, suspended. It's still in place, but it's suspended. So by the way they changed the rules, the reduction is zero for now. So it still can come back like all these things can. I think it's important, as Mark alluded to earlier, if nothing is done and we hit 2026, these come back. Anything that we wrote down as suspended returns if nothing is done. Again, pointing to this not being wholesale reform, but rather being some adjustments or tweaks to the current model. AMT. Before I go into what happened with the AMT, I always think it's good to maybe talk about AMT in general and what it is. So, alternative minimum tax. The best way to think about it, from my perspective, it is a parallel tax system. You figure your taxable income under normal tax rules, which says you can or can't deduct certain things. You take that as your starting point, and now you refigure things under AMT rules, which says you can or can't deduct certain things that you did or didn't deduct under normal individual income tax rules. Pretty simple, huh, Mark?
Oh, yeah.
So there's also this exemption.
Yeah, everybody wants to have to calculate everything twice.
Yeah, why not? I'll tell you, who the real winners in all of this are? The tax software companies who now have a couple weeks to start to make these changes for payroll and other things that are very quickly affected by it. So AMT, there was a lot of talk about alternative minimum tax going away. I've always heard that when AMT first came to be, the idea was you had a lot of high-income individuals, wealthier individuals, who because of the tax system at that point were bearing the benefit of all these different deductions and essentially not paying as much as it was desired that they would pay based on the progressive rate system, right? Our progressive rate system, by its nature, says the more you make, the more you pay.
Yeah, it was designed to say, okay, we get it. Yeah, the people with all the money to spend on tax planning and everything else, you're smarter than we are. You're going to figure out a way around this. But we're going to come back in and say, you know what, you made a lot of money. We decided you're not paying enough, so here, you have to pay some more. Problem is they didn't index it for inflation. So when they put it in, there weren't many people subject to it. And now, I mean, just last year, people that you would look at their tax return and, you know, they're certainly rich by the world standards, rich by U.S. standards, but they're not millionaires, and they're subject to the AMT. And trying to plan for that is just incredibly difficult because people obviously they want to know what their cash tax liability is, but they also want to be able to predict what it's going to be from year to year. And they don't just want to minimize it. They want to know what it is because no matter what the answer is, if they know what it is, they can plan around it. And so that made it very difficult to plan. So that's definitely a win and a simplification.
Yep. So AMT now still being in place, and typically AMT results in a higher taxable base for most individuals, but applies a lower rate. So AMT basically applies a 28% rate across the board. It does allow for special preferential rates for capital gains, but it typically results in you having a higher taxable base and then applying a 28% rate on it. The exemption amount that's part of AMT, which will bring down that taxable base, the phase-out used to be pretty low, where you would start to lose this large exemption that AMT afforded people. That phase-out has now jumped to $1 million for married filing joint couples. So what this means is far less individuals will fall within the reach of AMT. It goes back to being a little bit more exclusive in the individuals that will be subject to AMT. It's worth noting, too, that if you own a pass-through entity, the AMT, depending upon different depreciation adjustments and other things that are part of the entity that you own, it could, as Mark alluded to, you could just have interesting circumstances from year to year that may pull you within the reach of AMT or not. So these changes, while the AMT is not completely gone, these changes with increasing the exemption amount, from what we see and if we apply it to our experience with our clients, it will result in less people being subject to the alternative minimum tax. All right, and finally, this
actually before we jump into this next death spiral of an issue, which we'll get into in a minute. We just had a question pop up. What about if I'm in the middle of a mortgage that is in excess of $750,000? And Dan, correct me if I'm wrong, but I believe anything entered into before this bill came about is grandfathered in, including home equity lines of credit. Is that right?
Yeah, Mark, that's how I'm reading things as well. Correct.
Right.
Thank you. So, as Mark said, before we jump into this spiral, the new deduction for pass-through income, let's just start here. At one point, we were going to max the rate that individuals were going to pay on pass-through income, right? We talked about a max 25% rate. Then that was gone, and where we ended up is this new revolutionary deduction for pass-through income. So this specific area is really, of everything else, it's the most detailed, probably the most complex, the most layered. But I can tell you where it is on the surface is you get a 20% deduction for the amount of pass-through income that flows through to you as an individual. The mechanics of this work very similar to the 199 deduction, the domestic production activities deduction. Domestic production activities deduction gave taxpayers a 9% deduction on qualifying business income that was passed through to them. And essentially as if you manufactured something that was created in the U.S. and you had U.S. jobs, paid W-2 wages, you got that deduction. That deduction is gone now under this act and replaced by this new one. It's actually sharing the same code section, Mark, I believe, too.
Yes, we now have a lovely code section 199 Cap A.
Anytime there's a Cap A, you know that hard work has been done in Congress, whether it's 263 Cap A, 409 Cap A. So yeah, this new deduction for pass-through income, essentially, it's creating this new concept of qualified business income, similar to Section 199. There's overall limitations on wages, and and there's other things that go into play depending upon your income level. But one of the hurdles, for example, is if an individual has $315,000 or less of income, then they're not really going to be subject to a lot of those limitations, and they're going to get the benefit of 20%. A 20% deduction from pass-through income that flows to them from an S corporation, a partnership, also, of course, LLCs that are taxed as partnerships and such. So this is an area that, much like when the net investment income surcharge came out, and it gave a lot of incentive for S corporations as opposed to partnerships for tax purposes, this might be one of those areas as we dig in more and more to this, where there may be some planning opportunities for clients to maybe think about an entity change if, for example, it may allow for a better result from this deduction. But I think I haven't heard it yet in the media, but for those companies that had income that qualified for the 199 deduction, they're getting this new 20%, which is great, but they're also losing what was a 9% deduction. So the delta is now 11. Mark, they're 11% better from a deduction standpoint than they were. Still good, obviously.
Sure. Yeah. The difference is the key difference between 199 deduction and the 199A Cap A deduction is that 199 deduction was specifically tailored towards manufacturers and processors, whereas this is generally available to all pass-throughs, regardless of your line of business, with, of course, the exception of professional service businesses, which happen to include accounting firms.
How'd that happen?
Yeah, it's weird. I know.
Come on, AICPA, where's your lobby?
Yeah,
group?
Seriously, because we don't have employees. But anyway, so the premise behind this was the IRS wanted to say, okay, we're giving C corporations this giant rate cut, flow through businesses, which pure numbers wise, in terms of number of businesses, makes up the vast majority of businesses in the United States.
Right.
I keep saying the IRS. This wasn't the IRS. Congress said, well, okay, we're giving C corporations this rate cut. We want to give a break to companies who, for all intents and purposes, do the same kind of work, produce the same kind of product or service as C corporations do. They just happen to be organized as a flow-through entity. We want to give them a break too. So they said, but we don't want to say, okay, Mark and Dan, just because you decided to start a partnership and do the same work that you were doing yesterday, you're just now organized as a partnership, and then we're not just going to give you a rate cut when you would have just been earning money that's going to be taxed at the highest rate of 37%. We're not going to let you just organize this partnership, pay yourself something, and then all of the excess is going to be taxed at a lower rate. We want to say, okay, you need to be operating as a company with a whole bunch of employees that are getting W-2 wages, and if that's how you're doing it, you're going to get a break from this. So, as Dan said, the two guys in a truck who are organized as a partnership, would it make sense for them to switch to an S corp? Maybe, maybe not. On the surface, all of the things being equal, possibly.
Right.
However, anytime you do that, you're starting to get into the letting taxes drive your business decisions, which might help you from a tax standpoint. But there's always unintended consequences when you let tax drive your business decisions. So you need to be doing the calculations to say what's our tax going to be as a partnership. What's our tax liability going to be as an S corp? And then you have to say, well, what are the rules of an S corp? What are the rules as a partnership? Partnerships or LLCs provide you a ton more flexibility than S corps do. So if you're just organized as a partnership and you're just going to be operating that way, and it's two domestic individuals who own the company and you have no intentions of ever doing anything else, the differences between S corp and partnership probably don't matter to you, and so it might make sense. But this definitely falls into the category of you need to be aware of this, and you need to evaluate it to make sure that you're in the best possible position.
Absolutely. Yeah, and again, for us, on the advisory side, this, like Mark mentioned, is probably the area that we're going to be digging into a really a good amount to make sure that we are advising our clients accordingly. Mark, you just spoke about the conversation of, well, should I now be a C corp with this reduced rate? Well, depending upon how much or how little you're going to benefit from this deduction for pass-through income, that would help drive whether or not making a switch back to a C Corp, which for most of the time was never seen as the right answer for tax purposes. There might be situations where that might be the result. So much like everything in tax, there is no one-size-fits-all. This new provision does not mean everyone should be one certain entity or conform to one structure. It means the rules have adjusted and changed, and we need to look at it. We need to explore it, and as Mark said, run the numbers and factor in a lot of the non-tax aspects as well of that entity structure and what it means for your organization.
Yeah, it was just with this QBI deduction, the 20% deduction from pass-throughs, there was a Twitter battle going on between two guys who are much smarter than I am, and they just live in this tax legislation world where they just dig into this detail, and it's their livelihood to analyze every single line item of the code and regs. And they were having this Twitter battle as to what this section actually meant and how it was intended and how it's actually going to end up and what's it going to mean and how it's going to be calculated. And they never agreed. They never came to a conclusion where they said, oh, yeah, I agree. This is how it's going to be treated. So that definitely gives us all some pause. Excuse me. And to say, we need to dig into this further to see what the end result is.
Yeah, and I think just the way this works too, Mark, you alluded to earlier, the IRS role in this. I mean, the IRS is going to codify this law now, and they're also going to be issuing regulations, guidance on how these things are calculated, forms that actually calculate these things as well. So, and there are times when certain aspects of this are argued and would seem as gray, and the deciding factor in a lot of cases is the IRS's and their initial release of a calculation or regulation that they open for commentary, and then a lot of individuals through organizations like the AICPA or individually will comment on those proposed regulations, proposed calculations. We may see some adjustments, and then we kind of establish how this is going to be calculated on tax returns and enforced from there on out. So we got a long way to go to know exactly what that looks like, but I do think it's probably, because it's new in some cases, it's going to be one of the muddy ones for a while until it gets dug into a little bit further. All right, Mark, we spend a good amount of time on the individual side. What about the corporate side of things? What are some key aspects that you wanted to highlight?
Well, like we already talked about, the C corporation rate is dropping from max of 35% to 21%. That also applies to personal service corporations, generally consulting firms, accounting firms, law firms, architectural and engineering firms. They were previously taxed at the max corporate rate of 35%. They are now also getting the 21% benefit there. So that definitely applies to a number of companies around here. The AMT, the corporate AMT, is repealed. And what I was talking about earlier, where they had that glitch when the Senate passed the bill in the middle of the night, they lowered, at that point, they lowered the C corporation rate to 20%, but they left the corporate AMT in place, which is also 20%. And R&D credits, which are a massive tax break for manufacturers in the U.S. and all tech firms, software firms, a whole bunch of companies in the United States, the R&D credit cannot offset AMT. And so all of a sudden, the regular income tax rate was the same as the AMT tax rate, which meant that R&D credits were now worthless. So we all knew it was an oversight. They corrected it, and so we're back to now we're at 21%. So depreciation, we hear a lot of talk about fixed asset deductions. This, when you read through it, it looks pretty complicated. The end result is generally, if you buy a fixed asset that has a useful life of less than 20 years, you're going to be able to deduct it in year one. Whether it's through Code Section 179, which was originally meant for small businesses, but now the max cost of everything or the limitations on everything has gone up so dramatically. The maximum amount a taxpayer may expense under Code Section 179 now has been increased to $1 million, and the phase out of CapEx is increased to $2.5 million. So, most what I'll call small to medium businesses, they're just going to be able to slam everything through in year one and through 179. And 179 is permanent. This is not one of those things that that goes away after 2026 or whatever. The other piece with the fixed assets was what's been affectionately termed as bonus depreciation. That's been in place since 2001 in one form or another. The new law basically just says you get 100% first-year deduction for qualified property after September 27th, 2017, and before January 1, 2023. So if you're in charge of fixed assets at your company and you're out of 179 and you're looking at bonus depreciation, this is one item where you can go backwards. Pretty much everything else we've talked about kicks in 1/1/18. The bonus depreciation kicked in September 27, 2017. So for 2017, for businesses, there's a definite planning opportunity here, because if you've maxed out your 179 and you're in bonus depreciation now, if you had an asset that may or may not have been placed in service on September 26th, then you could argue that it was placed in service on September 27th. You might want to do the research and figure out exactly which day it was placed in service, because if it was placed in service on September 27th, congratulations, you can deduct the entire thing. If it was placed in service on September 26th, you only get 50%. So you definitely want to be aware of that. And this does expire. So January 1, 2023 is when it expires. So that's set to expire, which again leads to the good grief, can you just let us predict here what our tax liability is going to be? So, and just some commentary on this. I heard a lot of legislators. This is something that Pat Toomey keyed in on a lot. That if we give taxpayers the ability to deduct in year one their capital expenditures, they're going to increase their capital expenditures X amount. No, they're not. I mean, if you buy a piece of machinery that you don't need just because you can write it off in year one, that's still a really expensive piece of machinery. So if you're just out there buying machines that you don't need to get a tax deduction, let me know. I have a bunch of machines sitting here I'd like to sell you.
10 keys, specifically.
Yeah, my needs 10 keys, let me know. Slightly used. I don't think we have any paper for them, though.
No.
But, and the other key change here to bonus depreciation is that the first-year deduction is allowed for both new and used property. Before this law, it had to be brand new property. So the first use of the property had to be with you. Not just new to you, it had to be new to everybody. Now it's new or used property. So this is why I say if you have property that's the useful life of less than 20 years, most likely you're going to be able to deduct it in year one. So this definitely simplifies things. Makes our life a little more difficult because it just changes how everything's calculated again. And splitting it between 179 and bonus is just a change on the forms. But
well, then you have states that are, whether or not the states are going to conform to these new rules. Like, for example, Pennsylvania did not always follow both bonus or 179 exactly. So it remains to be seen. And then we go into a lot of our clients who are multi-state operations and
Yes.
understanding how each of these states will or will not conform to these new fixed asset rules.
Yeah, that's a good point. And Pennsylvania in particular, some years they followed it, some years they didn't. So followed what the feds did. So that definitely adds some complexity as well. And just to note, the 100-year or the 100% bonus depreciation starts being phased out in 2024. So in 2024 it goes down to 80%, and then subsequent years 60, 40, and 20. Mm-hmm. So after 2026, bonus depreciation goes away.
Mark, one of the things I wanted to point out here, we don't have it on screen, but correct me if I'm wrong, like-kind exchanges still in play for real estate, but gone now for all other assets?
That's correct.
So that, from our perspective, not a huge negative for taxpayers. Probably for a lot of companies, I think about vehicles. When they're constantly trading in vehicles and renewing their fleet, it just became more of an administrative burden than it was a true tax benefit. So now we've said like-kind exchange is still there, so the opportunity to defer gain if you reinvest in a new property is still there for real estate. which is the majority of where it was a useful tool.
And
it's
that's
now
what
gone.
it was originally intended for.
Right. So, hey, there's another simplification we can get behind.
Yeah, I agree. And just to note, if you're like, look, I don't really care about bonus depreciation, it's just going to screw up my fixed asset stuff, you can elect to only claim the 50% bonus depreciation from September 27th through December 31. After that, you have to do the 100 or elect out and just go to regular makers. Mm-hmm. One other thing I wanted to back up on the AMT. There's a question of, well, okay, great. I've been in my C corporation has been in AMT for the last 5 years. I have all these AMT credits. Well, how am I going to use these AMT credits? Long story short, you're going to be able to cash those in basically over the next 5 years. So I believe it reads, you get to, you know what? I'm going to find this and read the exact words so I don't screw it up. But you get 50% of the amount by which you could offset your regular tax liability refunded. So if you had a $20,000 regular tax liability and you have $30,000 of credits, you can offset the 20 and then 50% of that 20, which would equal 10. That's what my calculator tells me. You would get your full 10 back then in year one, in addition to the 20 that you offset of your regular tax liability. So you would be able to convert those to cash. And then I believe in 2022, you can get 100% back. So by 2023, everybody should have cashed in all of their AMT credits. Mm-hmm. Moving on to the 199 deduction. Back up, Dan. Like we said before, it's repealed, replaced with 199 Cap A. So it goes away for some, comes back for others. For the flow through on the C corporation side, domestic production activities deduction is gone completely. So that generally ended up to be about a net, 3.5% benefit to companies. It was a 9% deduction of income that was taxed at 34%. So, you go down to 21%, but then you take that back up. So you're back up at like 24. Mm-hmm. So the rest of this is basically going to fall into the category of things you need to be aware of.
Right.
The biggest thing being interest expense. If you're C corporation that is highly leveraged, then you may run into an issue where you can only deduct a certain amount of your interest expense. So you need to be aware of that and get the specifics. There's a special taxable income limitation that says, okay, if your taxable income is this, you add back depreciation and your interest expense, and then take a certain percentage of that, and then that might limit the interest that you can actually deduct against taxable income.
Hey, Mark, can I pause here and just, without getting too political, pause and mention the irony of the business interest deduction in light of President Trump's known history of being heavily leveraged in all of his business dealings to levels where he even, again, admittedly so, heavily leveraged in favor of high debt levels. But I just think there's a little bit of irony now with this overall limitation for C Corps now on some business interest.
I thought you were going to point out the irony of the debt that the country's now going to have to take on to pay for these tax cuts, which will hopefully pay for themselves in the long run.
I was going to leave that to you.
but in the short term, yeah. Anyway. Dividends received deduction. The 80% dividends received deduction is reduced to 65%. 70% dividends received deduction is reduced to 50%. We already talked about depreciation. The 162M. So public companies, there's a $1 million limitation on compensation deductions for the top 4 or 5 individuals, compensated individuals in the company. But there were many ways around that through performance-based comp. The performance-based compensation expense or exception is now gone. So every dollar that you pay any of your top 5 executives over $1 million is non-deductible. So public companies need to be aware of that.
So, Mark, let me just back up because that's a pretty big one, right? If it used to be, let's say, the base salary of said executive was, $950,000, everything else was in long-term incentive, they could still be getting paid 15, 20, 30 million a year, but because the balance of it was not, it was performance-based because it was part of, different part of their compensation package, it was allowed to be deducted. So now we're saying under this new act, that exception goes away. Any dollar over $1 million is non-deductible. Is that correct?
That's correct. And the old rules said that the limit only applied in a year for what's called a covered employee. What it says now is once you're a covered employee, you're a covered employee forever. So what companies would previously do is they would say, okay, we're going to pay you $1 million even this year because you meet the definition of covered employee. But next year, you're not going to meet the definition of covered employee, so we're going to pay you $1 billion next year, and we get the deduction for it. Well, now, I keep saying the IRS. Congress figured that out and said, too bad, so sad. Once you're a covered employee, you're a covered employee for life. So we're always going to deny those deductions. So that will be a permanent add back, although obviously taxed at a much lower rate.
So the benefit of using some of this excess cash for these publicly traded C corps that they now sit on because of this lowered rate to further bonus executives, at least we're going to limit the deductibility of some of those.
Yeah,
things.
and I think Congress did that on purpose particularly to fight the perception that this was just going to enrich the executives, that they're going to say, hey, we can't control what companies do. It might enrich the executives more at the expense of employees, but at least we're not going to give them a tax deduction for it.
Right.
So another thing to point out, NOL deductions going forward, this only applies to NOLs generated after 2017. NOL deduction is limited to 80% of taxable income. That's kind of an AMT concept also. So while we did get rid of AMT, we bring it back in little bits and pieces here and there now that AMT is gone. The other thing is meals and entertainment. Previously, you could deduct 50% of all meals and entertainment. Now you cannot deduct any of your entertainment expenses. So current limit of 50% is still applicable to meals. 0% of entertainment expenses, so now you have to make sure you split out what's entertainment and what's meals. Previously, if you had a cafeteria on site and you were providing meals to your employees at the convenience of the employer, that was not subject to the 50% limit. That is now subject to the 50% limit. So you need to be aware of that. Travel expenses, that's no longer tax-free to employees. And there's a few more here. I'm trying to figure out exactly which ones we want to specifically mention. And the last thing is lobbying expenses. There was kind of, I'll call it a minor loophole, where if it was lobbying on behalf of local legislation as opposed to federal legislation, it did not count. You could deduct it. Now all lobbying expenses, you cannot deduct any of them. So with that said, we've covered all of the big things. If you have any questions, please feel free to contact us. Again, a lot of these things are things you need to be aware of and things you need to be able to plan for. We can't answer or provide an answer for everyone because everyone's tax situation is different. We're just here to provide some guidelines, make sure you have the information you need to make those decisions.
Yeah. Mark, there was one question that came in actually from a former colleague of ours, Mr. David Riley, which is a good question. His question, and I'll let this go to you, was how does the tax reform affect the Cleveland Browns' chances of winning a game sometime in the next 3 years? Go ahead, Mark. I'll let you take that one.
If we could do something to help the Cleveland Browns' chances, I'm sure we would. However, at this point, I really don't think there's anything that you could do to help. I don't know. Maybe if Ohio would lower their individual income tax rates, you could attract some better players. But the weather in Ohio isn't always the greatest, so that there's nothing you can do about that.
I appreciate Dave thinking that Congress could fix, because I'm not sure that anyone could. No, honest, a real question that came in was, do you anticipate many C Corp elections from your pass-through clients, or will the higher PA Corp rate dissuade many of those conversions? And said, I'm sure that this is probably dependent upon how much compensations the owners want. Very true. And I think it's also dependent upon how much that qualifying business income deduction would be in this specific situation. Because we're closer now to the corp rate and the dividend rate being equal to the highest individual income tax rate. But when you factor in some of the qualified business income deduction, it may still put you in a position where you're better off avoiding C Corp. So, yes, to answer that question, it should be looked at. There's not an across the board, we have to go this way or the other way. There is no one size fits all, any magic bullet coming out of this reform that says definitely do X and you'll save money.
Yeah, there's a number of factors that go into play to determine whether or not you want to go to S to C. Dan, you mentioned most of them. Right now, it's definitely more of a question. The big factor that still plays into this that people don't think about, they're only looking at next year's tax liability, is when you're an S Corp, you build up your basis in your stock every single year for all the income that you're taxed on. C Corporation, you don't. So if you flip from C to S, or from S to C, your basis in your stock is frozen. So 20 years from now, when you go to sell your stock in an S Corp, you're going to have a much, much, much higher basis, assuming you're profitable, than you will in the C Corp. So you would have a much higher capital gain tax on the back end if you flip to C Corp. So, but it's definitely more of a question now than it has been. So we are out of time. I did want to mention one more thing. Cash basis of accounting before. Under previous law, you were generally limited from using cash once your revenue hit $10 million. They've upped that to $25 million. So that's another thing to keep in mind if you're on the accrual basis now, but the cash basis would be favorable. You should look at that.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. You can stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again, and have a great day.